What is up, guys? And thank you for sticking through that commercial break. We are joined by none other than the man who does research over at the Bitcoin Layer, my fellow attic dweller at his mother's house, but currently coming to us live from the 7-Eleven internet provided to him for free for his slushy. Joe Consorti, what is up, man?
We're chilling. Chris says that I'm good. Hey, can you hear me okay?
I can hear you okay now.
Okay, fantastic. How's it
All
We're
going?
going to
right.
go, but honestly, for our audience, this is the moment that we told you to be prepared for. Have those tomatoes on hand and feel free to just chuck them at Joe.
We have pickles
Yeah,
4K,
yeah, I'm
which
watching
is
the
better than
comments. He's,
pickles.
he's saying I'm fine, bro.
Yeah, pickles 4K is saying that Joe is in tune and on time. Q, I think the space cakes you ate in preparation for Amsterdam are hitting it. They're affecting you right now. Just stay cool.
Dude, I took
Joe and
those
I are
space
here for
cakes in
you. We're going to
solidarity
talk
because I'm
about
not
the
going to
the
Amsterdam.
larger economic environment, and we're going to be okay.
Fantastic. Thanks for having me, guys. I'm excited to get into it.
Yeah. So as P mentioned, we're gonna do a nice, fun little macro update with you. But first, if I can find what I find far more interesting is you and Nick went down the rabbit hole of, oh my god, why can I not the time value of the Lightning Network? So I'll let you set the stage of like what it is you guys are trying to figure out here and why, because this was awesome.
Thank you. Appreciate it. Yeah. So to back way up, like 2018, before I was even into Bitcoin, actually right around the time that I got this shirt, I think, was Nick originally published a series of Medium articles before he did Layered Money, before all of that, that were talking about basically like a Bitcoin capital market that could have been made possible through a reference rate, right? An interest rate that is, derived, that other, entities use to borrow and lend against, and the one that was derived through the Lightning Network, right? Parking your liquidity in a channel and then earning a rate of return on that. And if some way we could widely report a rate of return that you can capture from a Lightning channel, then that could be used as a reference rate, right? People could take a look at that and say, okay, I'm going to lend to you because, your credit history isn't as great as another guy at, a higher spread to, let's say, the United States government, right? And that's sort of the idea that Nick set forth in 2018. Since then, a lot has changed, especially in the Lightning Network landscape, where now not only do we have an example of a widely published interest rate, which is on Magma, which is basically a Lightning liquidity marketplace, but it also opens up the floodgates for a Lightning Network derived yield curve. Because the cool thing about this marketplace, not to get too far ahead before I'm just setting the stage here. Basically, on this liquidity marketplace, you can lease channel liquidity for a predetermined period of time. Now, what a yield curve is, you're plotting different maturities of a fixed income instrument like a U.S. Treasury through time, right? You're plotting them again, basically through time, and then all their yields. And obviously through time, it's more risky. You're exposed to higher interest rate risk. And so a higher return on your capital is demanded. And so basically on a yield curve, let's say a 3-month US Treasury is what? It's, 2.5% right now versus a 30-year, which would demand a higher interest rate. That's the idea that wasn't possible in the Lightning Network, because you could pull channel liquidity from any channel at any time. And so like standardizing a contract or standardizing, okay, if you park your money here for this amount of time, here's what you'll get, was impossible. But with Magma, they have basically minimum lease times where you could take, now there's a time attached to an interest rate, right? And that could open the floodgates to something like a Lightning derived yield curve. Now, why this is important is because, and I promise I'll stop rambling, but this is sort of the kicker, is because there are what, $900 trillion of liquidity, global asset value, right? And with Bitcoin right now, having a widely published interest rate is one thing, but having a yield curve and showing market participants who have hundreds of millions, billions of dollars that they can park their liquidity inside a Lightning channel for a given period of time and earn a set rate, that's huge, right? In terms of attracting market participants and making the Lightning Network something that's more efficient, pushing Bitcoin towards more so global capital market status, right? We're not at the same level as something like United States dollar denominated, bonds, right? It's something like $10 trillion in those versus 10 million or something like that in the Lightning Network. I could be off, but it's two nice round numbers. But needless to say, the Lightning Network needs basically a widely reported reference rate, so market participants can see that they can park their liquidity in a Lightning channel or on something like leasing out their liquidity, and they could earn a yield on that. They can, for corporate financing or what have you, that incurs less overall risk profile than something like a corporate bond, right? So that's basically the first half of the time value of Lightning Network. Those are sort of the advancements towards a widely published interest rate that we've seen in the last 4 years. That was the idea behind writing it, and yeah, no, I'm excited to chat more about it.
Cool. Let's unpack that because there's a lot there to unpack. And first, I want to attack this a little bit. It feels to me there's a degree in which you are reintroducing almost a credit rating system by showing which channels are more creditworthy than others. Why? Why do we need this, and why? And what is the ultimate goal in introducing or reintroducing this credit rating system now into the Bitcoin system?
Good
Wait,
question.
sorry. Is this about channels or about nodes?
Channels, because that's where that's where you park liquidity. I mean, individual node operators can run several channels. So I guess in theory, you would basically have like a reputation profile based on an individual node. Instead of like a channel's history. One quick correction real quick before I dive into that answer, because it's a really good question. There's actually $100 million in the Lightning Network and $100 trillion in dollar denominated bonds and equities. So just to make that clear for listeners, if they thought either of those numbers were wicked low. But there is basically in any form of lending, lenders need to know the risk profile of the person they're lending to. And obviously in something like Bitcoin, everybody's equal on the base layer. But when you get into actual, lending of liquidity, and this can be done in a far lower overall aggregate risk profile than something like a corporate bond, right? You incur a lot of counterparty risk when you have, when you're lending to a corporation. You incur far less counterparty risk. Let's say, you set up Lightning, in a channel. Or you're lending in multi-sig or any of these different things. Bitcoin as a whole, the Bitcoin and Lightning networks together, they incur less overall risk than the traditional, United States dollar capital market. So basically, a risk curve is necessary for lenders to see, okay, I can incur, I can get, let's say 3.5%, 4% if I lend to somebody off chain, because that's obviously the riskiest you could possibly do, is completely off the Bitcoin network. Or, I could earn 3%, right? You're sacrificing 1.5%, but you're doing this Lightning channel liquidity lease, which incurs, no default risk because you could close the channel at any time. Obviously you incur risks native to the Lightning Network, hot wallet risk, all these other things. But as a whole, you're not lending to a corporation where, somebody may not want to buy your bond on a secondary market and you're stuck with something that's plummeting in value, you can't resell, and you're getting barely any coupon off of it. So as a whole, that's the idea. I mean, we talk about, in Bitcoin, people are perceived as equal. Literally anybody can use the base chain to transact with one another. But when it gets into, borrowing and lending for financing, just like a traditional capital market, there does have to be some form of assessing risk profiles of different market participants in order for it to flourish.
So I apologize. I have not looked into this in depth yet, but I'm still kind of hung up on the idea of why are we talking about specific channels versus like nodes as a whole? And I guess, are these analyses is part of the kind of analysis compared to the risk of just a normal Lightning channel opening? Like how does that work?
Yeah, so I could be conflating the language there, but the reason I'm sort of interchanging the two is because it varies, right? At the bottom of your risk curve, you have cold storage Bitcoin, and then you have something like the Lightning Network reference rate. which is derived entirely at the node level. Nodes have to report the rate of return that they capture on their channel. And that's theoretical. That hasn't happened yet.
Got it. Okay.
At least widely and reported. Yeah. And then, the further you move up the curve, the reason I'm using the channel language is because on Magma, on this channel liquidity marketplace, that's what you're actually leasing from somebody. You're leasing not a node, but
a specific channel. Yeah, no, totally.
Runs.
That absolutely makes sense.
Before we dive into the magma of it, though, I want to spend some time on sort of the risk return curve that you guys introduced. I think, though, what I want to really get a better sense of is sort of let's talk this out. So we have on the risk return curve what you guys have sort of created. Talk to us about sort of what is the least risky to the most risky, and let's on each one of these sort of stop and explore them before just everything. Go.
For sure. I love it. Oh, and before we dive into it, by the way, this is not Monster Energy. This is water. Just for you, Keith.
I hate you so much.
No,
I'll be completely honest, dude. Like, I showed up to the office at Bitcoin Magazine HQ, and the refrigerator is full of yerba mate, whatever, because I guess Dylan LeClaire has infested Duke's freaking mind, as well as all these damn Red Bulls and all the LaCroix, whatever the hell, however you pronounce it. I like making fun of it. So I just want a Gatorade, man. Give me my sugar and water.
Dude, Gatorades are way too filling. This gets you yelling. Anyway, this is an absolute classic. Yerba Mates too. Up in Vermont, that's like what everybody, at least 3 or 4 of those every single day. Not me.
I hear Dylan LeClaire is just like the Yerba Mate just dealer up in Vermont. Like, it all funnels through him. He buys cases of it at a time. Then he's the main point of distribution. True or false?
Good Lord. I did see a pretty big fridge last I went to his last apartment. So won't verify, won't deny, but wouldn't be off the table, I guess. So yeah, with this risk curve, basically the first point, the point at the very, very bottom, the reason that it's here, and again, for people who are wondering what we're talking about, a risk curve is a way of illustrating the risk of different vehicles to park your wealth in a capital market. And as we go up this risk curve, I'll explain what the equivalent is to today's capital, United States dollar equivalent. So at the very bottom, you have and it's the way you do this is you plot the risk of an instrument versus the return. Risk on the x-axis, return on the y-axis. And as you move up, you have diminishing marginal returns. You take on an outsized amount of risk for slightly more amount of return. And so at the very bottom, you've got cold storage Bitcoin, right, which is non-yielding, right? You don't earn any native yield on your Bitcoin if you're holding it in cold storage. It's non-custodial, right, if you're holding it on your own. And it is counterparty free, right? It's an asset that is in somebody else's liability, which is really what you want in your money. Oh, fantastic. We got I love the screenshot app on Windows. You can pull those up really quickly. But yeah, as you can see here at the very, very bottom, and P or Q, if you want to pull up the second version of the graphic too, that one's a little bit more detailed. It's about 3/4 of the way down, but we'll talk about this one for now. So cold storage Bitcoin is non-yielding, non-custodial, right? And it's counterparty free. So no default risk with cold storage Bitcoin, right? Could it be in that safe directly behind me? Of course not. That's just to throw people off. So my live appearances, they think if I break into Joe's office, I can steal all his Bitcoin, but it's not really in there. That's a farce. And so you don't have counterparty risk, right? And you don't have custodial risk. This is exactly the same as physical gold in its risk profile, based on its risk profile, right? A lot of people don't like to make the analogy. A lot of people do like to make the analogy when introducing people, and it's helpful here as well, because if we think of physical gold, really, again, it has the lowest overall risk profile. The next thing up on the rung for, a United States dollar risk curve would be a United States Treasury. And of course, we've never defaulted on our debt in a major way. If you lend to the United States government, they're not going to explicitly default on you. They'll implicitly default on you through printing into oblivion, but they won't explicitly default on you. And so with something like the United States Treasury, you still have a slightly higher risk than with physical gold. So cold storage Bitcoin incurs the lowest overall risk profile, just like physical gold does. And basically plotting these against one another and sort of showing the equivalent in the United States dollar capital market was just to sort of B it so people could more easily understand. But yeah, that's the first point on the risk curve.
So
can I ask?
Go ahead.
I just want to jump in and ask, when we talk about the Lightning Network reference rate, one of the things that immediately occurs to me is that the specific strategy that one uses when one is, creating channels and basically managing liquidity across time has a massive, massive effect on what your return per channel is. So this is basically just an average across all existing Lightning networks. Is that correct?
So yeah, in theory, that's what it would entail. Basically what it would be is nodes would volunteer their information. So nodes would volunteer their APR, and then that would all get aggregated and averaged. The way you would do this is still up for debate, right? There's nothing like this in practice. Through time, I anticipate that this will come about. It's actually odd. We got the next rung up the risk curve before we got the Lightning Network reference rate. So we have like a Lightning adjacent reference rate that is derived from leasing channel liquidity, but we don't have one that's actually aggregated from like native node data. That would require, external coordination and then, aggregation and publishing by some entity, whether it be like a group, some sort of cabal of nodes. That's essentially what the LNRR would look like in theory. And again, like the reason we keep writing about this and the reason I made it a point to include in here is because one day that's going to be pretty major. LNRR, we tend to think of sort of the equivalent to the United States Treasury, like almost risk-free. It's called risk-free. It's what people use as their primary reference rate, but it's not exactly risk-free, right? Unlike physical gold and cold storage Bitcoin.
So let's define what these risks are in comparison to the cold storage, as well as what then are the greater opportunities for return. Because as in the previous image that we just saw, the LNRR is the next sort of step up above Bitcoin and cold storage, which
with those, I think the risks are pretty well documented. Or are you saying it's useful to our audience to basically just have those reiterated really quickly?
Probably the latter. We'll go with the latter. Yeah. So a couple of different things that are posed as a risk when you're operating a Lightning node and you have a channel or several channels is hot wallet risk, right? Let's say I have access to my channel and it's open on some like the password to it, how to access it, or the node itself is open on one of my computers or my phone gets stolen, computer gets stolen or hacked into in some way. Then those funds could just immediately be swept from the channel, right? So that is one risk. There's also inactive peer risk and forced closure risk, and both of these kind of go hand in hand. If you have an inactive peer on the Lightning Network, remember channels are between two Lightning Network participants, two Lightning Network nodes, and so if you have an inactive peer that won't settle up the channel, then your funds are locked in that channel, right? You can't settle up on the main Bitcoin blockchain. And this isn't even so much as a risk as it is like an inconvenience, because eventually, you can close out that channel. It just takes a certain amount of time. And so really the biggest risk with operating a Lightning channel to me would be hot wallet risk, right? Just that security aspect of it, not getting phished and somebody stealing your funds and sweeping the funds from the channel. That's the biggest present risk. And I'm sort of reaching when I say like inactive peer risk, forced closure risk. Those two are risks because, ultimately you get your funds back anyway. The reason, and it just goes.
Sorry to interrupt you. Could we define inactive risk? Obviously means users are not there. The counterparty is no longer there. They're no longer a part of this transaction. What was the second one you said?
Forced closure risk. So same deal. The channel just gets closed. You'd still have access to your funds, but the channel, every single one of its connections would no longer be there, which is an inconvenience, right? If you're like a big proprietor of Lightning Network channels and connections, like let's say River Financial, I'd say they're they're one of the most robust sort of entities that routes transactions. If they had like a massive string of forced channel closures, that would be not a risk to their business. They have other facets of cash flows, but it would just be a major inconvenience to their business because all these different relationships on the Lightning Network would be severed with that. So yeah, that's sort of what all of the risks are. And again, I'll say for any Lightning Network aficionados who are listening, I'm more of a traditional finance individual trying to project these sort of analogies onto the Lightning Network. I'm in no way, shape, or form a node running or channel operating expert.
If you have any issues with anything discussed, P is the person who is taking your side of these
God
arguments.
damn it.
And Joe and I are the.
I am biting the sides of my cheeks to be like, all right, like look, this is a rabbit hole. Do not drag us down into the technical bullshit.
We're going down a rabbit hole that people that are far more technically inclined and thoughtful most likely may not agree with a lot of things that we're discussing or even exploring here, and that's totally fair. You are entitled to not listen to this if you don't think that these are viable solutions.
No. We're trying to understand what's going on here.
Totally. I do think there's growing viability that, unfortunately, whether or not you want this to be the case, this is not something that I want. But when you see something like BlackRock's deal with Coinbase and you see Fidelity getting more involved with Bitcoin and 401ks, these traditional banking models and entities will reappear in Bitcoin, whether or not we want them to. And so there is, I think, utmost importance for us to dissect these things and really be critical of them in order to allow our voice to be the presenting sort of entity and ideas behind Bitcoin oriented financial anything. That's just otherwise it gets co-opted by the Fidelities and the BlackRocks. And then they just give us these reports and tell us this is how it's going to work now because we have the money to move the market that way.
I don't think anyone is. I mean, I'm certainly not arguing the other side.
Oh no, I'm literally fighting against myself right now.
Okay, that's what I wanted to be clear.
I'm a crazy person who just fought with myself.
Because I mean, like everyone in this conversation is a super good actor. Like we're all trying to understand like how Bitcoin works ultimately, how the Lightning Network fits into that within the scope of this conversation and all that stuff. So I feel like asking the questions that Joe is asking is always a good thing. Like I think
to some degree we're all charlatans, but you're right. Yeah, Q.
Q more than any of us.
Come on now. Over time, lightning banks will emerge, because people just lack the technical wherewithal to be able to like efficiently operate.
You're jumping like 45 minutes into my conversation with you. Stop. Stop. I love you though. Keep going. Keep going.
Yeah. So like with these traditional entities entering Bitcoin, it is an obscene amount of liquidity. BlackRock has $10 trillion assets under management, but also they're like a huge shadow bank. And Larry Fink's a character. I won't say anything in case my house gets hit or whatever. But these people aren't necessarily of the highest moral order. But again, they do have $10 trillion assets under management, so that a portion of that liquidity now can enter Bitcoin. And so it's this tug of war. And you're right. We do have to like have conversations about the implications of this stuff. So all of a sudden, we leave our Bitcoin in a hot wallet and our funds get swept by Larry Fink and his goons. Got to be careful.
Not a serious question, but who would you rather be your supreme leader, Xi Jinping, Vladimir Putin, or Larry Fink?
Okay, let's weigh the options here. I think Larry Fink, because you have like you get to play pretend that you're living freely. I get to play pretend I'm not being monitored all the time. Like even though I know for a fact that this camera is always on and recording everything I do, because the Patriot Act definitely is still a thing. We're still getting recorded all that. So like with Larry Fink, you get to play pretend like it's you're living freely. With Xi Jinping, you don't even get to play pretend. You know what I mean?
I guess. I mean, look, full disclosure, you've been DMing a Persian man way too much to not think that you are now like under legit watch by the NSA. So full disclosure.
Yeah.
Moving on to more serious stuff. So on the other side, the return. I just want to fully establish we have had this conversation on the show before our audience members who may not be fully aware. If you open up a Lightning channel, guess what? Those fees, you do get a cut of that. Mind you, we also established that like in order to like really make money here, you have to be routing a lot of fees. So realistically, is this a risk reward? And let's just go around. What is the risk reward ratio here? Is this a reward profile that's worth the risk that we have established? We'll start with you, Joe.
I'd say, yeah, in the way that it currently exists, yes. If you had a whole bunch of, because the barrier to entry is lower now than it's going to be, in my opinion. Like, I believe Lightning Network, with the functionality we just discussed of widely published reference rates, paving the way for huge bank-like entities to come into the game and earn this yield, it's going to be inherently more difficult for somebody like myself who does not have trillions of dollars in all of this technical wherewithal to manage channels efficiently. So right now, I think it's a pretty attractive risk to reward profile. But as more market participants come into the Lightning Network, as you see that capacity tick up, and it becomes more enticing to run a channel, run several channels, run a node, and route these transactions optimally to capture fees, then it's going to be more difficult. It's going to be more risky for somebody like the average market participant to do something like that. I feel as of right now, though, it's pretty attractive. We're still in the very infantile stages of all of this playing out.
P, at this current level of risk reward that we're talking, do you feel like the reward profile is worth the risk of an LNRR?
I'm going to answer a slightly different question, I think, which is basically, is the risk, should one run a Lightning node? I think is what you're kind of asking.
More or less, yeah, without literally making it that.
Well, I think the reason I ask is because I think the strategy changes. Like for me, me and a bunch of people, about 20 of us got together and started PlebNet, which, grew into this large thing. I haven't been super dialed in on it lately. I don't know what the current stats are, but there was a period where like we were the single largest group that were bringing people into the Lightning Network. And when I say bringing people in, I mean like bringing plebs in, because we were just like, we want to learn how Lightning works. We want to run our own nodes. We want to understand the nitty gritty aspects of what it takes to run a Lightning node. And, when we talk about the Lightning Network overall, I kind of think of it as like there's three different categories of users. There's like people who are like, I just want to be able to send sats fast and for no fees or for very low fees. And for those people, like you can use Lightning today through like Blue Wallet or Moon Wallet, which is one that we recommend a lot. That's MUUN. And there, you don't have to like take custody of your Lightning channels and all that stuff. You can just basically use the Lightning Network and it's fucking awesome. Then there's people who are like, I want to be a merchant. I want to accept funds via Lightning. I want to accept Bitcoin via Lightning. And then there's tools like, Breeze Wallet lets you basically like, you have like a little point of sale system and you can take money. Again, the advantage is it's very, very rapid final settlement and the fees are very, very low. And then there's people who are like, and again, I'm talking about plebs at the extreme end of the spectrum who are like totally nuts and are like, I want to understand how the deep nuances of this incredible life-changing technology. I want to run my own like telecom switchboard, which is basically what it means to run your own Lightning node as an individual, right? And that's super fun. And for me, it's always been really, really engaging because it's basically like a real-time strategy game. Like I used to be obsessed with StarCraft. And for me, being able to go in every morning and like check all the liquidity on all my channels and then, balance my channels through circular payments and all this other shit, that was really fun for me. But I want to be very clear that when we're talking about this stuff, you can use the Lightning Network and have no idea what's happening on the back end and just be able to have very rapid payments for basically no fees. And that works today as of right now. The reason I say all this is because I think your question was like, does it make sense to kind of like run a Lightning node right now? And I think it's very important when you're asking that question to frame it as like, are we talking about a single individual who is interested in, benefiting the Lightning Network and learning more about their own sovereignty, et cetera, et cetera, et cetera? Or are we talking about an entity who is trying to make money running a Lightning node. Now, you can make money as an individual, but it takes a lot of effort, right? And you're not probably going to make that much money yourself. So I think that if there are certainly economic niches that one can occupy as a business, and there are even economic niches that one can occupy as an individual. But I don't think that the average person should get into the Lightning Network right now, running their own nodes, expecting to make a significant amount of sats per unit time.
Almost like the original question, which was framed as, is the reward profile of this amount of risk worth it? To P's answer, no for individuals.
Well, I would
answer my own question.
It was important because I did not.
Exactly.
I think that so when the Lightning Network was first like really gaining traction, people love to like post on Twitter like #reckless, because it was like, you know, like, hey, we're fucking bleeding edge shit. Like, who knows? And I certainly lost funds learning how Lightning worked because I just like, you know, locked it up. I fucked up my channel openings, fucked up my channel closing. But we're not in that world anymore. The Lightning Network has matured dramatically since then. And it is 100% possible to lose funds on the Lightning Network by accidentally fucking something up. But the educational materials are so much more mature. So I actually wouldn't put it as a risk reward in terms of like, you know, where your funds could be allocated if not in the Lightning Network, right? Because I think when you're talking about risk reward, it's like you have to talk about opportunity cost. You're raising your eyes up as if you're like, Jesus Christ, he is not answering my fucking question. Is that fair?
I'll be fully honest, man. This office space is just too distracting to do the show from.
Yeah, Q has his face in like fucking like Megatron style TV that's like just like outside of his eye line, so he's looking at his own reaction, and it's horrible for him.
That's extremely. I would not like that at all, dude. What happened to doing the show from your mom's basement? My mom's attic is working just fine, dude. I routed this Ethernet cable 150 feet.
Look, I'm in.
You fucking did it.
My landlord tried to raise the rent, and I'm in deep negotiations right now with my landlord on the insane amount. Yes, my mom tried to raise the rent on me.
Yeah, man. Well, hey, I mean, there's always this office space that you can sleep in.
Okay, wait. Jumping all the way back though, Joe, I'm curious what you think here. When we talk about risk reward profile, the ROI of an individual is always going to be very different from the ROI of a business. And I think as an individual, like most individuals are not viewing it from the perspective of like, how much could I be making if I was loaning my Bitcoin out or doing something else instead? And I think that factors into it. Tell me if I'm totally butchering that, Joe.
No, you're 100% on it, because as of right now, we already rely on intermediaries with expertise to facilitate our payments. And this idea that every single aspect of a Bitcoin Lightning denominated economy would be decentralized is silly. Personally, that's what I believe. And with something like the Lightning Network, you're exactly right. Individuals care about it, not because, you know, little Timmy living in Botswana right now, who is, you know, his under intense political strife, cares about earning yield on his $5 that he parks in the Lightning Network. He cares about being able to transact right over the Lightning Network and not be censored, and do it in a way that is extremely low fee compared to the Bitcoin main chain. So that's the idea. You know, for individuals, it matters less, because what they're focused on, what they use the Lightning Network for, is the Lightning Network's utility, and that's sending Bitcoin, right? Not on the main chain that's secure, that's like moving gold bars on a tank, but more like, you know, verifiably taking those representations of Bitcoin and then transacting them infinite amount of times across this network before finally settling up. That's what the individual cares about. This entire piece is more so for large bank-like entities who have a lot of capital to deploy, for corporations who want to raise funds in some way and are looking to, you know, experiment in new ways and potentially be first movers. That's basically what this publication is for. It's for, you know, this theory of a Bitcoin Lightning denominated capital market and how we could get there. And how we get there is through publishing a widely reported rate of return to attract a lot of collateral, so market participants can buy and sell collateral to meet their loan obligations, and then, you know, eventually that spurs off into a full-blown Bitcoin denominated capital market. That's the idea. You know, that's what this paper is for the average individual just using the Lightning Network. to to transact. They've got their Bitcoin in cold storage, but periodically they re-up their funds to their Lightning wallet and just use it recreationally. You're going to have little to no risk, right? Just remember your phone password, don't download any fishy things, and basically you'll be fine, right? It's sort of an extension of what we already do in our own lives. We rely on a lot of intermediaries to get everyday things done. I'm relying on Citizens Bank to not close off my credit cards, right, in order to go out and buy this water, right? And so in a Bitcoin denominated capital market, same as today, people at the individual level will rely on these people who have more technical expertise in managing Lightning channels in order to facilitate these payments. That's just how it's going to be, right? When the fishes get so big, that's basically how sats are going to move across the Lightning Network.
Just so you know, Joe, this is what water looks like. Doesn't like some water comes in a can, but
what does that have to do with anything? Oh, okay. This is a reference.
You don't understand the beef that Joe and I have.
Yeah,
neither does anyone else in this fucking chat. Everybody's like,
no, I'm ignoring everyone else in the chat today. You guys are lovely. I love you all. Shout out the OG homies, D348, Goblin Hunter, Gobble. I honestly, your name, I have no idea what it is. I make up a different version of it every day I see you in the chats. I know you guys are all there. Hammersaw. Shout out to all of you guys who are tuning in repeatedly. All right, I want to move on to Magma. Talk to us about, Joe, just what is Magma, and like throw out a comp for what exactly it is in traditional financial markets, because this exists, in my opinion.
It does. Yeah, it's very cool. It's sort of akin to Magma can be thought of basically, you're lending to, whenever you want a rate of return, whether you know it or not, you're lending your money to somebody. And Lightning Magma is essentially this Lightning liquidity marketplace where you can lease ownership of your Lightning channel for a period of time and earn a rate of return on top of that. So with the Lightning Network, there are two. Basically, this is a completely separate method of generating yield. With the Lightning Network, you're routing fees. Okay, so you have a channel and you're earning a base fee, right, on all your transactions, and a fee rate. And that is your APR. That is your interest rate that you're earning. With Magma, it's basically a marketplace where you could sign in with your node. It's really, really cool. Everybody should go check it out, amboss.space/Magma. You can browse it. You don't have to be a node operator to take a look at it. And so essentially, you can lease your Lightning channel liquidity, or you could buy others' Lightning channel liquidity for a minimum specified period of time. And that is essentially basically the way that you borrow, the rate that gets determined at which you borrow, has nothing to do with the Lightning Network itself. It is completely separate from routing transactions. The rate that you're borrowing at is actually set at the moment of sale, and it's set by the person who's leasing their Lightning channel liquidity. And so because this isn't derived, as I mentioned earlier, from like native node data that would have to be self-reported, aggregated, averaged, this is more so basically Magma. What they do, Amboss, they aggregate all of the APRs for that week, and then they average them and they publish them. And this is basically an APR that gets determined off of a variety of proprietary factors, but it's separate from like the routing fee rate that you would earn on the Lightning Network itself. So it's like, it's an auxiliary Lightning Network reference, auxiliary to the Lightning Network reference rate. So in traditional finance terms, basically corporations, they borrow at a spread to something, to a reference rate. In the case of Magma, this can be thought of as being liquidity that gets leased out at an interest rate at a spread to the Lightning Network reference rate, which is theoretical. It doesn't exist yet. This is not unlike a reputable company like Apple borrowing at a 0.5% spread to the United States 3-month Treasury bill. That's essentially what the equivalent is here. That is what's called, Apple can borrow at that rate. They borrow at US 3-month plus 50 basis points. This Magma APR is sort of Lightning Network reference rate plus however many basis points you're borrowing at based on the risk profile of the person who is, or based on your own personal rate of return that you set at the time of the transaction. That's essentially the comparison I would use, right? So whereas the Lightning Network reference rate is sort of the risk-free rate equivalent, a Lightning liquidity lease on something like Magma is sort of, it trades at like a basis point spread to the Lightning Network reference rate.
So have you looked into or included in your analysis, tools like Lightning Pool? There's a few other ones that provide it sounds like provide a similar service to Magma.
Yeah. So with Magma, the reason I used them was because with other providers, and you mentioned Pool, they were actually the first one to do this, I believe, have a liquidity marketplace by Lightning Labs. Unreal, absolutely very, very cool thing. They did it much earlier than Magma. With Magma, you don't actually have to have a node to log on and take a look at all the data. And so that's why this was sort of the route that I went down. But I did include because I wanted to make sure that I was using all the correct language and not saying that Magma was the very first, but they're the first widely published, right? So there isn't like a barrier to entry in terms of running a node. I dropped Pool by Lightning Labs, and also one other thing by Lightning Labs down in the sources at the very bottom, just for posterity's sake. But for this analysis, I used Magma.
Yeah, it's interesting. Like I said, I have not played around with Magma, but I do love Amboss. Jestifer is a friend of the show, awesome dude.
He's fantastic.
One of the creators of Amboss. Very, very patient. When I was learning all this stuff, I'd be like, "Hey, how does this work?" And he would jump in and answer any questions I had. One of the things that's interesting about Lightning Pool, and I suspect that it's gotten a lot better since the last time I was trying to participate in it, which was probably over a year ago at this point. So take everything I'm saying with a grain of salt. But the system, like the sort of rating systems that were used to determine whether or not a person could, purchase or lease liquidity, were at that point fairly opaque, and they had to do with boss scores, which is something that was, sort of proprietary algorithm. I wonder how Magma is doing it, or is it literally just if you have the funds, you can?
Yeah. So Magma, they do it. It's also a proprietary thing, but it's all on their their Git book, right? So you can go to docs.amboss.space, and then all of this is publicly available. This is like a total treasure trove of the way that Magma works, and basically your ability to borrow and lend, and like the rates that you can borrow and lend at. And this is all like information that's available, is aggregated into something called reputation. So like not unlike a traditional credit score, like, credit worthiness of large borrowers, the Magma reputation is sort of like the Magma equivalent of that. And it's 20% track record, 30% speed, and 50% reliability. And so those are the components of this reputation score that go into the rate at which somebody can borrow and lend. Basically, are you a good channel peer, or are you not a good channel peer?
Got it.
So let's talk about, why do we need Magma?
For sure. So, and not to sound like a broken record, but basically a widely published rate of return on invested capital, that's the precursor to a capital market. A capital market is, basically a slew of financial instruments that people can purchase and people can sell. And that's what denominates, that is what will push Bitcoin to a reserve currency status. The reason the United States dollar is a world reserve currency, is because it's not because of our military might and our prowess and how pretty Joe Biden is. It's because we have a deep and liquid trillions of dollars capital market that has a slew of financial instruments for people to park their United States dollars in. And that is essentially the precursor to any capital market is, are there instruments that I could put my wealth in that I can capture a rate of return with? If there are, I'll allocate capital towards it, right? And that's how that burgeons and expands. And so Magma is one of the first steps in order to making this happen, right? We talked about Lightning Pool by Lightning Labs. There's also LN Router, but Magma is, again, another one entering the space. And this is good developments that you want to see. The more widely published rates of return you have, market participants can go and compare rates. They can say, do I want to park my wealth here? Do I want to park my wealth here? And that's the utility of Magma. That's why we need Magma. And also the more that's the like grandiose, this is going to lead to a global capital market reason for Magma. The more granular reason, the actual utility of it, is to secure inbound liquidity, right? For node operators, one of the hardest things when you're just starting out a channel, is securing inbound liquidity in order to route transactions. And there are several solutions for this. One of them is to use Magma and to lease your liquidity if you efficiently operate a channel and earn a rate of return on that. And if I was a new node operator, I could borrow some of that liquidity, get started. There's also with Voltage, who's a sponsor of the Bitcoin layer, they're fantastic, is they just launched, basically you can get inbound liquidity directly from Voltage, right? So that overcomes one of the major hurdles in starting out a Lightning channel. But that's the granular reason for why Magma exists. But the big grandiose reason is that the more of these basically rates of return that are published, the more market participants have the ability to compare, and ostensibly, that will lead to more and more liquidity flowing into the system. If there was no sort of instrument that market participants could peruse, and they had to do all their own due diligence and dive down these esoteric rabbit holes like we have, then Bitcoin and Lightning wouldn't grow beyond a certain point. At a certain point, the people and their businesses that are dedicated to creating these methods of earning actual yield, they're the ones that are inching us closer to sort of this Bitcoin denominated global capital market. So that's the more grandiose reason for something like Magma. The more of these that exist, the closer we are to that eventual future.
So I want to be careful about how I phrase this. But ultimately, like the catastrophe or the mayhem that we bore witness to earlier in 2022 was due in large part to a lot of promises about yield. And I have to ask the question of what is necessary about this, that like while we're not introducing another token, while this is to help further develop the Bitcoin layer and in turn the Lightning Network layer built on top of the base layer, how does earning yield, or at least pitching it as earning yield on Bitcoin, a positive thing?
Because it's actual yield. We've mangled the definition of yield so much, and I want to be careful with that for the viewers. There's a distinction between yield from nowhere and yield through efficiently routing transactions. With efficiently routing transactions, you're providing a service that requires your expertise, your active channel management, your active security, your active, working to build robust security around it. That requires a lot of human capital, and routing fees are people paying you for that service, right? So this is like an actual business actually earning yield. So that's what you have over here on the Lightning Network side, right? When it comes to this yield concept that has been jammed down our throats over the last several years, and really blew up in people's faces over the last 6 months earlier this year, is not yield. What it is essentially, and I think I talked about this the first show that I was on here with you guys, but it's essentially yield from nowhere, right? So yield, which used to mean you are investing capital and then you're earning a return on that invested capital because that capital is being used. Now yield just means either that capital is being taken and parked in extremely risky protocols, like this DeFi stuff, Aave, Sushi Swap, whatever Celsius was doing, or your yield is coming in the form of a completely worthless token that gets printed out of thin air. And the definition of yield has been so mangled. And so when people hear, oh, Lightning Network is a way that you can earn risk-free yield, right? It requires active channel management. It requires a lot of liquidity in order to make this profitable, right? Because you have to, build these connections to actually get transactions. Because again, we're in the very early phases of this, so it's not as if it's yield from nowhere. There's a tremendous amount of work that goes into building out a profitable Lightning channel, and then actively managing that Lightning channel and establishing new connections. And at the end of the day, the yield you're earning is from providing a service, right? You're developing expertise and building out a profitable Lightning channel, and people pay you for that in the form of the Lightning Network searching for the most profitable route for your transaction to go to. So that's sort of the distinction I would draw for the listeners. There's yield from nowhere, where you're parking your funds with basically a casino essentially, and they're paying back additional funds to you through creating new tokens, or through taking your entire deposit and putting it with an extremely risky borrower. That's the distinction I would make. Perhaps new standardized language needs to be made in order to draw the distinction, because the word yield has been so mangled over these last couple of months that, to some degree, you really need to explain with Lightning Network how all of this works, so people are incentivized to park their funds. For the time being, it's going to be a scary prospect for a lot of people that lost tens of thousands of dollars in these horrible protocols that were offering promises they couldn't keep.
I'm just prepping my motion for the next cult meeting of all Bitcoiners, and we'll be putting forward a motion to forever remove the word yield from all Bitcoiners' vocabulary once and for all. Because I think, to your point, it has been co-opted to mean 5,001 different things, and unfortunately, the most recent iteration of the word yield has a very negative connotation instinctively. I'm just waiting for when Rug Pauls, honestly, I refuse to learn how to pronounce that man's name properly at this point. But when Rug Paul decides that, the Lightning Network is my next best bet to siphon money into my pockets.
Nobody won't.
And why is that, P?
Big
Story time from our elder statesman.
No, I mean, because to your point, the types of strategies that he is interested in are not actually
effortful.
Yeah, exactly. They're not effortful. They do not involve providing a service. So the way the Lightning Network works, to Joe's point, is that like you provide a service to people, and it's as I said, for me personally, it's been very enjoyable to sort of like figure out like what are effective strategies, and by that I mean like where do people need liquidity, where they are like where is liquidity underserved in the Lightning Network right now. Like you can go and you can find these sort of like isolated communities, and when I say isolated, I mean like they don't have significant high value like channels to sort of these like large economic nodes, and you can sort of like be the intermediary there and provide real value. Whereas Raw Paul and people like that are primarily interested in basically just finding opportunities where they can, I would argue, take advantage of the market to make lots of money very rapidly, which end up being, in most cases, kind of Ponzi-esque schemes.
Yeah. So printing a token out of thin air, coming up with some sort of marketing budget from some entity, getting a whole lot of people to pile in because you have a very large platform, and then systematically dumping your money onto this newfound liquidity before you exit, you make a profit. That's what the name of the game is for some of these larger scammers, right? With the Lightning Network, to P's point, it does require a lot of expertise and a lot of effort, far and away beyond sort of this snake oil salesman-esque methodology that a lot of these people who have been trumpeting the idea of yield, that isn't real yield, like to employ, right? So it's too effortful for some of these people to sort of co-opt. And, if they were to be like, yeah, I'm going to use this as my next way of scamming people, like in saying you're going to scam people, what are you going to do? Are you going to set up all these, brand new Lightning channels with hundreds of millions of dollars of liquidity? Thanks. Like, you just actually benefited users of the Lightning Network, So, it sort of dissuades people who are trying to be bad actors and just get liquidity from unsuspecting market participants, and more so attracts good-natured entities, who are looking to earn a yield through putting their expertise out, providing a real service to people.
Okay, I've sidetracked the conversation enough. We can go back down the proper rabbit hole, and this is, I think, the most important part of the conversation that you guys introduced, and it's the conversation around Taro. Joe, do you want to set the stage for us?
Taro's cool as hell. So Taro is an in-development protocol by Lightning Labs. I hope I use the correct vernacular when I say protocol. Again, not an expert in this. But they announced it at Bitcoin 2022. And essentially what it is it is a method for issuing new assets and routing them via the Bitcoin primary blockchain and Lightning as well, right? So a lot of people will take a look at that and go, oh no, shitcoin, right? There's the possibility of that. But there's also the possibility of all the world's currencies flowing through Bitcoin's liquidity, right? So leveraging the security of the main Bitcoin blockchain, right, in order to issue, send, and hold stablecoins. A digital euro, a digital dollar running over the Bitcoin blockchain. Think of this not in our terms, because the three of us in this call, we may not need dollars in Bitcoin in the same wallet, like actual wallet, as somebody, in a more impoverished nation that, can't withstand the volatility of something like Bitcoin, but the censorship resistance of the blockchain and the transactability of the Lightning Network is something they need, but they can't take the volatility. This circumvents that in a major way. So Strike has a similar business model to this, right? But with Strike, they rely on, being able to basically hold dollars in Bitcoin and send dollars and somebody else receives Bitcoin, but it relies on good banking relationships in order to occur, right? All of this is occurring on Strike's databases. With Taro, it essentially makes that concept of holding Bitcoin and dollars or whatever other currency in the same wallet, and it makes it native to Bitcoin itself, and it makes it native to Lightning itself. So that's essentially what Taro allows for. And, this extends that concept of a Bitcoin denominated capital market we just talked about, because now not only are you attracting a crazy amount of collateral to Bitcoin with these widely reported reference rate that have ostensibly lower risk profiles than traditional finance, but now you're also attracting market participants who wouldn't have otherwise invested if there wasn't like a dollar instrument on there. So now, there's basically this opens the floodgates. Again, this is, as of right now, I'm no technical expert, but, this would open up the floodgates for, dollars, euro, yen, yuan, any actual, fiat currency that you could think of, or a stable coin representing that being held in the same wallet as Bitcoin and transacted across the Bitcoin and the Lightning Network. It's pretty revolutionary. And so, now what would have otherwise been, a rather large capital market on Bitcoin, now you can have a Bitcoin denominated capital market that has traditional finance instruments on top of it, right? So now you're running dollar instruments, you're running euro instruments across these Lightning Network rails, across this counterparty free settlement network. I may be getting lost in the weeds, but to getting a bit too excited here, but that's essentially what the prospect of this holds in my eyes.
So let's talk about where this would then fall in comparison to things that are already, full. I'm probably going to use the wrong verbiage here, but I was going to say fully flushed out, like Magma, for example. Where does it sort of fit in this risk return, and how does it sort of relate to the others as well?
Yes, of course. So, again, I'll back up to basically, for people who might just be tuning in, with a risk curve is visualizing the risk and return profile of like these investable vehicles within a capital market, right? Within a deep and liquid market for purchasing and selling financial instruments. In traditional finance, you could essentially visualizing that as gold being the least risky, providing zero return, US Treasuries providing some return, being slightly more risky, and then corporate bonds, equities, venture capital, all of those are slightly higher up the ladder. My dog is barking outside the door. And then in Bitcoin, something like Taro would exist a little bit higher up the risk curve, not because of any inherent Lightning Network flaw or obviously there is more risk incurred on the Lightning Network, but with something like Taro, the variability in the risk profile, and of course, what goes in line with that is the return demanded on that risk profile, that fluctuates probably pretty wildly, all in line with the creditworthiness of the asset issuer, right? When you're this is all theoretical in my mind. Like if you were to borrow or lend in an asset that was issued using Taro, you're incurring all of the associated risk that you would with the asset issuer, depending on the asset issuer. So like if the United States government, they wanted to issue, when they were, doing a treasury auction, they want to issue, $1 trillion of 3-month T-bills over the Bitcoin network and try it out. Obviously, that would incur much less risk than, me, if I wanted to issue a bond through Taro that was denominated in Dogecoin in order to go buy a grill or something. I don't know. Right. So at like these Taro assets, borrowing and lending them, like in theory, they would have all the assumed risk of whoever's issuing the asset. Again, I could be totally wrong on that. I haven't, the Taro is early in development. The technical wherewithal of understanding all of the documents are way over my head. But, in a Bitcoin denominated capital market, you would sort of say cold storage Bitcoin incurs the least risk. Lightning Network, natively operating a channel, incurs slightly more risk. A liquidity lease, right? Giving your liquidity to somebody else, slightly more. Taro, right? All of the different risks associated with the issuer, slightly more. And then, of course, at the far end of the curve would be off-chain lending, right? So you're not getting the benefit of the security of Bitcoin when you're lending, but you're using, let's say, the Lightning Network APR that you earn as a reference rate. That's basically the risk, like the theoretical future Bitcoin Lightning risk curve. And I feel Taro would be somewhere towards the middle / upper end of that, but it would fluctuate wildly depending on, the creditworthiness of the issuer, or the reputation rather, I think is a better word, of the issuer.
I just want to draw attention to the fact that in this risk curve that you just spelled out, at the extreme, like, yo, you fucking crazy, is like you give your Bitcoin to somebody else and then just hope that they're going to give it back to you one day, which is exactly what is presented as kind of like the standard when we talk about places.
That sort of uncollateralized lending is exactly what Celsius was doing, man.
Exactly.
Your customers were parking their funds and basically saying, all right, 20% yield here, do whatever you want with it. That's the far, far end of the Bitcoin risk curve. I wouldn't even call it Bitcoin risk curve, the wider crypto, in quotes, risk curve.
Yep. Oh, speaking of which, we were talking about a story, just to take us completely off track, recently around this document that was like all Celsius sort of creditors was released. And it was like thousands and thousands of names. And we were like super excited. We were like, oh shit, WEF is in here. Fucking Klaus getting fucked up. And somebody pointed out online, fucking BTC Incorporated, Bitcoin Magazine was also in this list. So I have to assume that it was basically everyone from any possible source that Celsius owed money to. So, they were sponsors of B21 and B22. So I'm assuming that basically those things were not paid and then they are still being waited on. So
probably like when you enter bankruptcy court, not to interject, but like you grasp for, like, you have to have due diligence down to like the atom. And so like, yeah, in something as interconnected as like a borrowing and lending system, sure, the World Financial, the World Economic Forum probably has something to do with the way that my car, was that my car loan got created, right? Yeah, that's interesting. I haven't dove into the document extensively, or as extensively as Dylan. I think he loves tearing through those documents more than I. I'm not a big, tearing into the nitty gritty granular stuff to the same degree as him, but absolutely crazy. Come on, guys, quit lending to Celsius.
Yeah, 100%. So, Joe, shifting slightly, what else has got you? What else are you focused on right now in terms of the Bitcoin ecosystem? What technological innovations? What areas of the progress that is being made has caught your attention? We've been talking about Lightning a lot, but I'm curious where else you're focused.
For sure. So really Taro, I think, Taro sort of, it paves the way for, like I mentioned, it's sounding like a broken record, but like a deep and robust market for collateral completely underwritten by the Bitcoin network and can be transacted across the Lightning network. And so that is probably like forefront of mind in terms of what I want to continue trumpeting, in the articles that I write, in the sort of theoretical research that myself and Nick continue writing. That's one of the things that I'd like to explore more. I think over at Lightning Labs, they're doing some pretty remarkable stuff. They really are, in terms of pushing us towards something like a global capital market that subsumes all the world's liquidity, because you could hold all of your currency, basically everything you'd ever need, and you could have the security of the Bitcoin blockchain, and you could have that transactability of the Lightning network, right? I think Taro right now is probably one of the least talked about things, because we already everybody collectively marveled at Strike and what they were doing, and it is absolutely remarkable what they're doing. But essentially, Taro is sort of an offshoot of that. It's a very similar concept, but it will be completely native to this network that is underwritten by an asset that, when it's custodied, has zero counterparty risk, right? It makes it completely native to Bitcoin. So as of right now, I'm really, in terms of Bitcoin technology, I'm really watching, Taro and to the best of my ability. In terms of wider markets, there's a slew of other things that I'm taking a look at the Bitcoin layer. With Nick, one of the things that we try to do is really take a look at Bitcoin, but through a rates lens, through a macro lens, a much wider view, so we can be as impartial as possible on like where Bitcoin is on this proverbial path to world reserve currency status, what its correlations look like, how responsive it is to rates, because ultimately, the rates, credit, these are the things that run the show. And really, I spend a whole lot of my time monitoring those, taking a look at where those are at, and trying to, probabilistically say what's going to happen in the near future.
I'm back. I had to go confirm what P was saying. I felt like the opportunity was there, and of course everyone was on the phone. No one could confirm it. But I do believe that that part of the list is only people regarding Celsius and why the fuck BTC Inc. showed up. Unconfirmed, or I'm trying to find the exact answer, but it is said that section was because they at one point or another did business with us, and that is why we showed up on the list.
Yeah, exactly. That's what I was drawing attention to.
Yeah, I don't think we're owed money by them anymore, because if we are, we ain't never seeing that again.
Not a chance. I think in terms of the creditor, the priority of getting back to creditors, I think the World Economic Forum, unfortunately, is probably higher than you guys on that list.
What?
Whoa, hang on a second now. You would rather pay the WEF than Bitcoin Magazine? Get him off this show. Get him off.
I wouldn't rather pay the WF than Bitcoin Magazine. I know that Klaus Schwab and his goons would be at my front door if I owed money to the WF and Bitcoin Magazine. I paid BTC Inc. first.
All right, look, you're behind the 8 ball now, man. Now you have the NSA and the WEF coming for your mom's attic. Like, you better buy your mama some flowers tonight and apologize for the shitstorm that's to come. Joe, before we go over to the macro, because as you've mentioned, you guys do an excellent job of, looking at Bitcoin through the lens of macro, which is so vitally important right now. Is there anything else we didn't get a chance to touch on regarding the time value of the Lightning Network? What you guys have sort of done here? Anything else you wanted to touch on?
So really, I'll just end by basically like almost going verbatim on the abstract of this paper and why it's so important. Just to give basically, a sound bite or whatever. But with the Lightning Network, with these formalized lending practices, just like liquidity marketplaces like Taro, like Lightning Pool, like LN Router, these are going to facilitate greater economic activity that's native to Bitcoin, right? The Lightning Network has already positioned itself as the capital market layer for Bitcoin, offering a rate of return on invested capital, and then also offering a slew of options of financial instruments to attract collateral, right? And collateral is the precursor to this major wide sweeping capital market. And so you've got that, and then Taro sort of brings this multi-asset functionality to the table that will broaden the scope of that capital and money market that's underwritten by Bitcoin, underwritten by the Lightning Network, right? So that is essentially what I'll leave it at. This is very revolutionary stuff. The people and businesses that are making this happen, Amboss, Lightning, Lightning Labs, everybody else that's working on it, these are the people that are paving the way for the future. I'm just doing my best over at the Bitcoin layer to bring that information to the public and sort of put it through a legacy financial theory lens so that traditional TradFi market participants can take a look at this, and potentially start positioning capital into the Lightning Network and into Bitcoin.
So when none of us can afford a Bitcoin because all of TradFi has officially bought up all the last cheap sats, we can point our fingers at you.
No comment, potentially.
Like truly excellent work over the Bitcoin layer. If you are not subscribed to their newsletter, Joe will tell you where to go at the end of this, but I highly recommend this whole discussion. There's a paper that Joe and Nick have written up. If you have not yet had a chance to read it, please go ahead and do it. It's Monday and I'm fumbling over my words, but let's talk my favorite topic, which is macro. And specifically, you guys at the Bitcoin layer spend so much more time focusing on bonds and interest rates, as they seem to be telling everyone and everything what the hell's going on. So what are you guys seeing? What are you guys paying attention to? And what is your definition of a recession?
Yeah. So there are a couple of things we're monitoring, right? Again, we sort of use rates to lead all of our discussion, but there's also a few key economic releases this week that will, as you mentioned, sort of push us closer to a recession. As of right now, CPI, the expected CPI is 8.7% year on year, and that's releasing Wednesday. And so any miss on CPI whatsoever would mean, and a miss to the upside, that'd be very bad. That'll basically give the Fed the green light to absolutely decimate the economy in terms of continuing the rate hikes, pushing for a higher terminal rate, pushing for a terminal rate that's further out. Basically, before the labor report, there was consensus in the market, and I had thought to a pretty large degree that the Fed was going to have to wrap up relatively soon, specifically because taking a look at the 2-year yield, that was coming down, and essentially, the 2-year yield leads Fed funds. So the 2-year yield is forward policy rate expectations. And so when, wherever that moves, the Fed essentially has to move. And 2-year yield, that was coming down because presumably, the rates market was telling the Fed, hey, it seems you've already tightened enough. But with the strong labor report, that basically is the Fed's first green light that they can continue hiking higher and potentially into Q1 2023 because the economy seems stronger than we anticipated. Obviously, their mandate is to kill inflation. If the CPI print comes in hot, if it accelerates year on year, those are nightmare scenarios that would basically give the Fed full steam ahead. Their runway was already extended, seeing that we have a strong labor market. A CPI miss would give the Fed full steam ahead to just absolutely plow the markets and say, all right, 3.5% terminal rate in Q1. Now we're going for 4%, right? Which obviously isn't a sustainable thing, but CPI accelerating, that's their number one concern right now. And so all eyes are on CPI really on Wednesday. And that's one of the big things we're watching right now, but also taking a look at rates. So as I mentioned, the 2-year yield really leads the Fed. If you take a look at a graph of the 2-year yield mapped against the federal funds rate, you can really see that when the 2-year yield falls below the Fed funds rate, the Fed is forced to pause their cycle. And as of right now, there's about there is literally right now, I have it in front of me, a 71 basis point or 0.71% spread between the 2-year yield and Fed funds. So the Fed still has 71 basis points of clearance to continue hiking. If all of a sudden the 2-year yield were to drop, pretty expeditiously, that could happen if, again, if CPI prints the way we want it to. The 2-year yield could begin its ascent back down to earth, because that's the market basically saying, all right, Fed, you've done enough work. CPI is decelerating. Then that would be sort of the case for the Fed pausing, after September potentially. And then, we'll see what the 2-year yield does. But essentially, that's one of the big things we're monitoring. We're also monitoring the 10-year yield, which represents forward growth and inflation expectations. So if that's coming down, that's also the market signaling that they feel the Fed has done enough work to slow down inflation and slow down the economy. And that caught a bid in the recent couple of that's begun to sell off again in the recent couple of weeks, and the yield on that has bounced up from a low of 2.5, which we actually called over at the Bitcoin layer. We called for 2.5 a couple of months ago. It's bounced back up to 2.7 now. So potentially, again, this is mirroring what the economy believes growth and inflation to be. If we get a CPI miss, then you could probably see this climb a little bit higher. So we're also watching now. We're watching 5-year inflation swaps, which are inflation expectations for 6 to 10 years out. That's actually one of the instruments that the Fed watches to see if they're doing their job on fighting inflation. And those have started actually coming down in the last week. And so there are several different signals, basically all going back to this same road of, okay, if the economy is still rip-roaring hot, we got this jobs report. If the economy is still rip-roaring hot from a consumer price index inflation standpoint, then the Fed could, really put on their hats and hunker down with the hikes. But that's basically all we're watching right now. The 2-year yield is still trading relatively wide above Fed funds, but basically monitoring that is the most important thing to be monitoring. The relationship between the 2-year Treasury yield and the federal funds rate, that is our signal for when the Fed is going to pause. And then, people are calling for a pivot, I believe, too soon. They forget that there is an intermediary phase between a hike cycle and a pivot, and that is a pause. And chances are, if things play out as we believe, or as I believe, rather, I don't want to put words in Nick's mouth, but we might be looking at a pause sooner than most think. I think people are conflating a pause and a pivot. A pause is far more likely than a pivot would be. If we have this massive, awful deflationary spike, asset prices get sent through the floor, yeah, you'd get a pivot. But if the economy slows down like the Fed wants it to, you get a pause and you normalize around wherever we are now, right? Wherever they end up at, 2.75 or 3%. Long-winded, but that's essentially what we're looking at. What my personal market expectations are moving into CPI on Wednesday. All eyes on CPI.
All eyes on the CPI, which will come out on Wednesday. We saw the jobs report. We had a long discussion with you as well, Joe, on Friday that these numbers may look good on paper or at initial glance, but could actually be a lot worse than we're anticipating. So we have the jobs reports, we got CPI, PPI, all that nonsense that they're going to feed us. Is there any other economic indicator that you think you're paying attention to that will impact the Fed's decision making?
Yes. So they look at the spread between the 3-month and 10-year yield. That's the literally last rate I'll mention, because I know a lot of people find it tiresome. But the Fed watches 5-year inflation swaps, because that's forward inflation expectations 6 to 10 years out. And they watch the spread between the 3-month Treasury bill and the 10-year Treasury note, right? So that's what they watch. Basically, if we watch the 3-month 10, because we know the Fed watches these things, they may not look out further along the curve, which they should, because they could prevent a lot of catastrophe if they looked at the 5-year inverting with the 10-year, but they don't.
That is the funniest thing you have ever said. You mean to tell me you think it would be helpful if the Federal Reserve did their job?
I think it'd be really helpful. They're not even remotely prescient, and they don't try to be. They really don't.
He's single, ladies. For the one girl that's out there listening, Joe Consorti is single, lives in his mother's attic.
I live in my mother's attic. Q, I think that's giving the show a little bit too much. I don't know if there are any girls listening. But anyway, a couple of other things to look at is, oh gosh, what was I going to say? Blah, 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 blah. Oh gosh. Well, you've got PMIs, obviously. Good Lord.
The 310s are inverted.
Yes. So 310s are 21 basis points away from inverting. That will be a huge other signal that the Fed has gone too far. The Fed would basically, at this point, they're being pro-cyclical. So the Fed's supposed to be counter-cyclical, right? During these huge boom phases, they're supposed to tighten the reins on the economic horses and slow us down a little bit. But instead, over the last 2 years, they decided to continue easing well through all of this. And then, so, when we're in a boom phase, they ease. And now that we're slowly going into a bust phase, they're tightening. So the Fed is being pro-cyclical. I was going to say, about jobs report. Yes, the jobs report. So the labor report, that was it could be a bit misleading. So non-farm payrolls, that a massive beat. It is a massive beat, but it could be somewhat misleading. You want to be watching more leading indicators there, which would be jobless claims, right? So initial jobless claims, watching those as those tick up, as those continue ticking up. That's basically what you want to watch, right? So there is like a nightmare, and this is what I wanted to say. So there's a nightmare scenario where the Fed takes a look at non-farm payrolls and uses that as its sole barometer to say the economy is red hot right now. Let's continue hiking. 75 basis points is probable in September. Even if we didn't have a red hot labor market, 75 basis points would still probably be what we're getting. But we basically know at this point that 75 basis points, according to the Fed funds futures curve, which is really never wrong when we're this close to a meeting, is pricing in 75 basis points. But there's a nightmare scenario where the Fed, CPI comes in hot, and they take a look at, or even disregarding CPI, they use the non-farm payrolls meeting as their sole barometer to say, look, the economy is doing great. Let's do another 75. And then they increase their terminal rate. They push out when their terminal rate is going to be. So they go harder and longer. And then, the non-farm payrolls beat was a fluke. As it turns out, there is an obscene amount of jobless claims, and you just made money way more expensive than you should have, Jerome Powell. And then that sends markets to the floor, massive deflationary bust. That is a potential scenario. That's like a nightmare scenario. And I think that could be made potentially even worse if we have a CPI miss and the Fed is even more emboldened to hike beyond what the market can take. Because if this CPI is supply side driven, which I strongly believe that it is, right? We seized up supply chains for 2 straight years and we're still doing it. If this CPI is supply driven and the Fed is rapidly increasing the cost of money, and if the labor market is less strong than the Fed believes and they're rapidly increasing the price of money, then you could have this crazy deflationary bust because the Fed tightened way too much when in reality, the economy was already self-correcting in the other direction. So a lot of different fun scenarios to play out, but really watching CPI, watching 2s, 10s, 2s Fed funds, and 3-month 10s and 5-year inflation swaps. That's basically where eyes are right now, as well as how's the consumer doing. So looking at UMich consumer sentiment, looking at the small business optimism index. These are sort of all the things that we use to paint the clearest picture. We don't use too many beyond that, because if you use literally a million indicators, you're painting a more muddled picture than a clear picture. Simplicity is really key if you want to have like a concise and pretty accurate picture of what's going on. But that's the outlook for the next couple of months.
Before I let you go, and before I just want to remind everyone in the audience, we will be joined in just a moment by the Bitcoin Magazine Pro will be joining us. Dylan Leclerc, Sam Rule, in about like a few minutes. So hang tight. I'm not going to let Joe go away because I have one more question for him. If you are not yet subscribed to our channel, just press that button right there. I'm finally figuring this out. All the way down there, just press it. Press the subscribe button. We'll really appreciate it. If we get up to 100 likes while we are live, we'll drop some stats over in the YouTube chat. Joe, one thing that you said stood out to me, and I want to ask this final question. Inflation has 2 causes, supply and demand. Yeah. I have personally felt like the root of inflation, you can equate these things not necessarily equally. I would say it's probably 75% demand driven, 25% supply side driven. You said that you feel like supply has a heavier hand in inflation. I'm curious what would your percentage be for each allocation each's allocation towards inflation?
Yeah. So instead of talking like allocations, I'll talk like probabilities. You saw a lot of key metrics like new orders seizing up over the last couple of years, like completely seizing up. Obviously, new orders are cyclical, right? So similar to commodity prices, like, lumber is very cyclical. They ebb and flow sort of in this sawtooth pattern. You saw new orders really, really take a huge hit. And as a function of that, consumers were still spending because they had a whole lot of credit, drives prices up, right? A lot of it is supply shock driven, I believe, because of that. So I believe, like, probability wise, I'm assigning probably 70% supply driven inflation versus 30% this consumer price inflation index inflation, and then 30% of it can be ascribed to demand side inflation.
But your rationale for the supply side of the equation is the fact that demand was so high that it actually took away supply, and then because we weren't manufacturing supply, that increased demand fucked over supply.
Yeah, so obviously with the monetary and fiscal easing that we had, people had more readily disposable income. But also, I wouldn't blame the consumer. I think the majority of it was caused these huge exogenous supply shocks that we experienced over the last 2 years.
Okay. This will probably be a discussion we pick up most likely in the Twitter sphere. But Joe, where can people know what the heck you're doing, what the heck the Bitcoin layer is doing, stay up to date with all your guys' research?
For sure. So I'm on Twitter at Joe Consorti, at first name, last name, no space in between, as you see it on screen, and subscribe to the bitcoinlayer.substack.com. And once again, the bitcoinlayer.substack.com. We have a free tier. We do a free market update every single Saturday, as well as 2 paid posts that you won't want to miss, covering everything Bitcoin, macro, and rates.
Thank you so much, man. This was fantastic.
Absolutely. Thanks for having me on after my terrible internet the last time.
Yeah, this is light years better. I'm so grateful that Nick paid you a decent enough wage so you can go plug into the 7-Eleven internet downstairs. I'm going to run to the restroom. We're going to be joined in just a moment with Dylan and Sam. I think P has some very smart words that everyone should listen to and do everything he says. Do not fuck this up, P. Do not fuck this up.
Oh, God. Roll the tape.
I got to pee.
We'll be back in a minute.